The primary issue in the world economy is a change in structure. The polarity of the financial system has effectively reversed. Who were lenders are now borrowers, and who were borrowers are now lenders. The whole system has changed. That makes it very, very complex to understand. But effectively what the system is now is based around the wholesale money markets. And what those need is good quality collateral. And the question is, you don't have it. The Federal Reserve has been taking collateral out of the system, and governments are not issuing treasuries anymore. Austerity policies are basically rooting the roost. So what there is a big pushback onto private sector collateral. And we know that is of flaky quality. If that deteriorates, the collateral base shrinks, liquidity plunges, and markets drop. That's the big risk. Central banks need to be in the front seat. How do we gauge the central banks? Which are the most important? There are two big ones out there. They're both of similar size. If anything, the People's Bank in China is slightly bigger than the Federal Reserve, the other one, but both are very important. China's People's Bank effectively controls the tempo of the Asian economies and emerging markets, and the US is basically there for the developed world. They're both very important to watch. Errors by either of them can cause serious problems. How are we going to be positioned in this environment? Well, look, risk exposure is nothing like as extended as it was in 2018. People have become a lot more cautious. That suggests to us that we can afford to be risk-on to some extent, and what you're seeing in markets is a lot of cross-border money coming back in, rather like 2016. That clearly, we think is an opportunity to be in risk assets. But we're cognizant of the fact that we're going to get more December 2018s. There'll be Karafasis, and you want to avoid those. So you've basically got to position your portfolio, number one, diversified. Okay, and we think looking non-US is critical because for the last 2 years, you've only really had a Wall Street bull market and maybe even a FANG bull market within Wall Street. So let's look outside. Let's look at Japan. Let's look at China. Let's look at the UK, which looks very undervalued because of all this Brexit nonsense, but it's a very cheap market. And possibly even start to look at Germany. These are some opportunities. On top of that, you need bond defense. And you need treasuries in your portfolio, US treasuries, but what you want is exposure to big outside moves. What that means, wonkish concept called convexity. That's what you basically got to embed in the portfolio. Convexity, which means exposure to outside bond moves. Effectively, the whole issue that the world is really facing is a problem of liquidity and a problem of duration. These are the two concepts that when I started at Salomon Brothers were paramount. These were things, liquidity, the doyen was Henry Kaufman, who did the original work on flow of funds, and Marty Leibowitz basically was Mr. Duration. These are the concepts that are coming back now. They're the critical things for investors to understand. The bond markets are important. The most important price in the world is the price of the dominant economy's debt, and that's the US Treasury.